Dan, all the events of last year, it really led to opportunities for PIMCO to manage risk and capitalize on markets by delivering alpha for clients. How are we evaluating markets now with 2023 in the rearview mirror as we look ahead to 2024?
Sure. Well, as you said, 2023 was quite an interesting year. You wouldn't necessarily know that if you looked at starting valuations at the beginning of the year, where we ended up. But people are beginning to romance the notion of a very, very high probability of a soft landing. The data has been consistent with that view, but we do think markets have likely gotten ahead of themselves a little bit. So given the fact that we tend to, at PIMCO, think about the probability distribution of potential outcomes, we assign a higher probability than what the market's implying. So we think it makes sense to protect against those tail scenarios in a world of considerable uncertainty, war in Europe, war within the Middle East, inflation still high and policy rates quite restrictive. Be a bit more defensive, be a bit more careful in the more economically sensitive areas of the overall opportunity set. But again, real great value in high quality sectors and segments of the market. Last year was quite volatile, and a lot of these higher quality sectors, because of that volatility, are trading at levels that are attractive from a historical perspective.
Let's take a few of these things in turn. The yield environment today, even after that strong rally that we saw at the end of the year, we're still relatively attractive in terms of the level of yield. Attractive, cheap. How should investors evaluate the opportunity set, just kind of where we are today?
So today, in terms of thinking about a portfolio construction, you don't have to take a tremendous amount of interest rate exposure, but by extending out the yield curve, by moving into more traditional fixed income sectors of the market, we do see pretty attractive opportunities. Again, across popular passive alternatives, when you add the ability to generate some other incremental return, things look pretty attractive as well. The other point I'll make, it's a simple point, but an important point, is that fixed income's not that complicated. You have some inherent cushion or predictability from the starting yield. So not surprisingly, the starting yield of a high-quality bond portfolio is a very strong predictor of what forward returns will look like. The Barclays Aggregate Index today is yielding about 4.5%. If you add some out-of-index high-quality exposures to that opportunity set, you can quickly get up to a 6% or even higher type yield, again, being fairly defensive from the standpoint of overall interest rate exposure. That type of historical return typically bodes well versus cash. It also looks pretty damn good from a risk-adjusted perspective versus equities as well. And the last point, and probably the most important point, one of the most exciting areas to talk about in the markets today, is that global bond investing's back. Less synchronized cycles, both from the standpoint of the real economy, inflation cycles, central bank policy cycles, geopolitical challenges, just a lot going on in a market that, again, just a few years ago was quite quiet, with rates negative in a lot of key areas of the world and significant volatility suppression from policymakers. So optimistic on alpha-generating opportunities, but still with an up-in-quality bias and a global lens in terms of putting together the optimal portfolio.
Yeah, a handful of things to do from an asset allocation perspective, certainly. What's your advice for investors today?
Yeah, I would say patience is one of them. I think it's important for investors to step back and look at valuations from a long-term historical perspective and just how attractive the broad global opportunity set will be. But realize, although volatility may be lower than what we've experienced the last couple of years, it's still going to be quite high. That's very, very hard to deal with. The fast, extreme, roller coaster is something that, most people don't love, at least in the context of investing. But if you have a multi-year time horizon, you're sufficiently diversified, and you're not making it more difficult than it needs to be. You're looking to protect yourself and not overreach in a world of significant uncertainty. We think there are going to be attractive returns to be generated, again, over a 2 to 3 year horizon, with a lot of zigs or zags or ups and downs along the way. And we're here, trying to assist clients on that journey together.